The Treasury auctioned $65 billion in notes and bonds this week. Treasuries surged on Thursday following the $11 billion sale of 30-year bonds, which drew the highest yield in almost 2 years. George Goncalves is the head of fixed income rate strategy at Cantor Fitzgerald, one of 16 primary dealers required to bid at Treasury auctions. He is joining us now to discuss this week's Treasury auctions, look ahead as well to next week. George, glad to have you in the studio with us. So based on what you've seen so far this week, pretty successful activity?
Yeah, given the backup in rates that we've seen, this week was a seminal week in terms of how the auctions went. There was a lot of trepidation and concerns about how the auctions were going to be handled, and as we learned, they went without pretty much a hitch, and things went over pretty smoothly. The paper got placed, and there was actually really strong demand.
So do you see this as forecasting what's to come next week in the next few weeks?
Well, next week we don't have Treasury supply, so we're on this on and off kind of cycle where there's this paucity of supply, and I think next week, given that we really only have CPI inflation and PPI inflation to worry about, I think given the backup in rates, a lot of that is already priced in. It's already priced in the tips break-even markets, in my opinion. I think a lot of the inflation concerns are a little bit far-fetched given how early in the cycle we are in the recovery. So I think, given the backup in rates, we've seen value players show interest at these auctions.
Would you think, as far as tips go, I mean, is it the right time to buy tips? I heard you say the market is over-anticipating or over-exaggerating inflationary concerns, but maybe now is the time to buy when they're still far ahead, when we can still afford them. It's good value.
Well, tips break-evens were oversold last year on the deflation concerns. We had massive deflation. The Fed has cut that off, and now is going to provide at least a situation for mild inflation, or there's going to be a tug of war between inflation and deflation. I think that the jury's still out in terms of who's going to win in 2009. In the years hence, if the Fed's policies work, which I think they will, we will see moderate inflation, but I don't think we're going to see runaway inflation where a lot of market participants are playing. And at this point, with 10-year break-evens at 2%, that's pretty much at the middle of a range where I would call normal growth. And the U.S. by no means is in normal growth territory yet. So
But some economists say third quarter we'll begin to see GDP go positive, but you're saying we're still a long way away from the recovery?
Correct. So I'd rather see that happen before it fully priced in. The tips market has run away from a lot of it due to the supply concerns, the optics showing yields higher than where they should be. I believe that 10-year break-evens probably would come back down to the 150 level in the next few weeks.
On a scale of 1 to 10, how confident are you that the Fed will be able to absorb excess liquidity when that becomes an issue?
They're doing various things. A lot of these programs, by nature, roll off in the future. A lot of investors showed concern with when the Fed said they were going to buy treasuries up and down the curve. And one of the reasons why I believe they're doing that is they know that at some point these treasuries will mature. And the same thing with these mortgage backs, they will prepay. So there will be a natural exit strategy once we get there, but we're way too early to be thinking about that.
George, really quickly, best value. I'm a fixed income investor sitting on the side. I have money. Where should I buy on the curve?
I think yesterday's 30-year auction showed where value was. The back end of the curve has high yields. We haven't seen these yields in quite some time. They're usually only here when we have true economic recovery. We're not there yet. I'd be buying the back end of the curve and shying away from some of these other fixed income markets like credit and mortgages that have had a really good run.
All right, George, thanks very much. George Goncalves there, head of fixed income rate strategy at Cantor Fitzgerald.